Hello and welcome to Rebank. I'm your host, Will Beeson. Today we're joined by Bhanu Kohli of Layer 2 and Mike Giampapa of Galaxy Ventures. Bhanu is the co-founder and CEO of Layer 2 Financial, a B2B payments company leveraging stablecoins for faster, cheaper payment processing. Mike Giampapa is general partner of Galaxy Ventures, focusing on the intersection of crypto and financial services, security and DeFi applications, and developer tooling. In this conversation, Bhanu, Mike, and I discuss real economy applications of stablecoins, including payments. We compare Layer 2's performance, economics, and business model with traditional payments companies, and look at potential applications for stablecoins in financial markets more broadly. This conversation was a fantastic look at a rapidly scaling real-world use case for crypto and the disruptive potential of blockchain as technology infrastructure. Thank you very much for joining us today. Please welcome Bhanu Kohli and Mike Giampapa. Bhanu Kohli and Mike Giampapa, welcome to Rebank.
Thank you. Thanks for having us.
Good to be here.
It's great to connect with you both. We've had a few conversations offline. I'm really interested in the work that both of you do. Bhanu, the company that you're building, and Mike, your perspective on all things crypto, and I guess specifically for the purposes of today's conversation, stablecoins. Bhanu, 10 years ago, if you were building a payments company, if you were building Layer 2, you would have been doing it with fiat. And you would have been using probably some different infrastructure, some different partners, and some different rails. But now it's another story. What's different about what you're building now in 2024?
Right. Yeah, so good question. What we're doing in Layer 2 is we're building a global regulated payments infrastructure to speed up money movement by leveraging both digital assets and fiat assets. And what that means is we're using digital assets to enable faster money movement across jurisdictions. And then we're using local high-speed payment rails to enable last-mile delivery. Breaking up the problem in this way allows us to not hold large amounts of treasury or be dependent on one or two banking partners or be dependent on SWIFT. It allows us to find the best digital asset liquidity partners to on and off ramp into local currency, and then find the best banking partners to provide that last mile payment collection and delivery that's needed to take the money from the source and deliver it to the destination. This just would not have been possible if we were building the company. Even as early as 5 years ago, you would have had to either hold treasury positions with banks or use SWIFT. Both models have limitations. Holding treasury positions limits the amount of money you can move, and you're dependent on just one or two banking partners in each region that want you to hold funds with them. Then they will give you access to their prized FX desk, and then they will give you access to local payment rails. Setting up each one of those banking relationships takes a long time. And they really do take advantage of that by not providing you the best rates, which means you cannot provide your customers the best rates. Digital assets have kind of changed the game. They're taking control away from the banks when it comes to money movement, allowing more options. It's an open ecosystem, so we can work with the best liquidity partners. We can work with a Galaxy. We can work with a B2C2. We can work with Enigma. We can work with these liquidity partners to on and off ramp in local regions. And then we can find the best banks that have the best APIs, that have access to the best payment rails to finish the last mile delivery. Again, just wouldn't have been possible even as early as 5 years ago. But now with the explosion of digital assets and explosion of stablecoins specifically, it's a game changer.
Wow. All right. So let me maybe ask you a series of basic questions just to make sure we're super clear on the business. So we're talking about cross-border payments, and we're talking about specifically offering those to business users. So this is not remittances. This is businesses that need to make payments across borders.
That is correct. Most of our customers and most of the volume going through the platform today is from businesses. We do have some remittance clients and some remittance and customers that do personal remittances. But the real value add of our platform is businesses moving large sums of money. That's where the platform really shines.
And specifically across borders.
Correct. Cross borders, because when it comes to, let's just take the US as an example. US has a good FedWire system. US is now launching FedNow. It's easy to move money, large sums of money inside the US very quickly within 15 minutes. And with FedNow, it'll be faster. So the problem we're solving is not necessarily how do you move money from one bank in the US to another bank in the US. The problem we're solving is how do you move money from one jurisdiction, call it the US, to another jurisdiction, call it Europe.
Perfect. All right. So I think there's a lot more that we can unpack throughout the conversation, because to the uninitiated, to the non-payments experts, what you've just said, sending money internationally, sounds simple when you put it like that. But I think under the hood, there are many, many layers, many, many complexities. But Mike, maybe before we do that, taking a step back and thinking about stablecoin payments in general. I think you and Galaxy have done a lot of work really thinking about what the current applications are, where traction is, where real volumes are coming from, where revenue pools are being accessed right now. Talk us through at the high level the stablecoin payments opportunity as you see it.
I think this opportunity is one of the most interesting trends in all of, not just crypto, but all of financial services. So if you rewind, I mean, the original use case for Bitcoin was around a peer-to-peer payment system. And for a number of years after Bitcoin's launch, there wasn't that much to write home about in terms of crypto payments. And it wasn't until stablecoins really started to gain adoption in the market a few years ago, and the market structure really built up around crypto payments, both in terms of more performant blockchain infrastructure, but also market makers and other liquidity providers. The whole market structure has been built up around the industry globally that has enabled crypto to be leveraged for the payment use cases that Banu was talking about. So this isn't a new idea, but it's something that the industry has been slowly sort of marching toward over time. Initially, stablecoins were primarily used as a form of collateral for trading purposes. The use case was largely around trading on exchanges, for example. We've seen other use cases emerge. People talk a lot about the use case of consumers and businesses in emerging markets or developing countries, maybe, that want access to US dollars, maybe don't have easy access, or maybe there are capital controls in place. Stablecoins have created the opportunity for a global store of value for individuals and businesses who want to store their wealth in stable currencies, which is a huge value proposition for a large part of the world. This is a very non-US, non-developed country perspective. It's a massive unlock that anyone around the globe can get access to digital US dollars with a cell phone. That is a step function change in accessibility that did not exist just a few years ago. The third use case for stablecoins is really around payments, and what Banu is describing. A few years ago, we stepped back and we said, okay, if we're going to see crypto blockchains disrupt payments, like, where would we see it first? And if you go through a matrix of consumer to consumer payments, consumer to business payments, business to consumer payments, or B2B payments, and then also overlay domestic payments versus cross-border payments, and you analyze the complexity, the cost, the time it takes to actually conduct those payments, you quickly uncover that cross-border B2B payments are the most complicated, the most fraught with friction and cost and intermediaries. And it turns out that blockchains are really good at moving money around the world, cross-jurisdiction, very, very quickly and cheaply. So we sort of set out to find interesting companies like Layer 2 that were building along those themes. the hypothesis was if we were going to see disruption in the payments ecosystem, we would see it there first. And I think that is starting to play out in a meaningful way.
So, Bhanu, maybe making this very tangible. Who are your active customers today? Where are they from? And what sorts of businesses are they operating?
That's a good question. So, we provide infrastructure. So our direct clients are fintechs, new banks, payment processors, banks are coming online as well from all over the world, really. The end customers we're serving are primarily corporate customers, as we spoke about earlier. And these corporate customers, interestingly, when we started, they were mainly, call it Web3 companies, right? That had stablecoin assets and wanted to move money efficiently, maybe make payroll payments. But what we've seen over the last 6 months to 7 months really is an explosion of the types of businesses and the variety of businesses that are using our platform. We have technology companies, consulting companies, e-commerce marketplace, agriculture companies, manufacturing companies. I like to give this example. The oldest company on our platform is a company that was founded in 1970, grain company that is using our platform to move money efficiently. Most companies now on our platform are now Web3 native. They're Web2, in some cases, Web1 companies that are leveraging the power of fiat assets and digital assets together to move money efficiently.
So some of these businesses, and maybe a growing segment is what you're saying, are basically real economy, offline businesses that either just need to, for kind of supply chain reasons or paying invoices, need to make payments. And they are aware that they're leveraging stablecoins or blockchain rails, or as far as they know, they're just using a great payments solution, which is cheaper and faster than what they could access elsewhere.
Sometimes they're not aware, right? Because these companies, they would use payment processors or banks to move the money, and then these entities use us in turn to move the money more efficiently. So in some cases they are aware, in some cases they are not aware that crypto is powering some or all of the experience of moving money faster, right? So for these payment processors, as an example, they can go and market to their existing client base and say, hey, we can move money for you now at T+0 fashion. If you're in Argentina and you want to pay your supplier in China faster, guess what? We can do it much faster. Just give us money in local currency and we will deliver it to your Chinese supplier in a T+0 fashion or T+1 fashion, which is a step function change from what would have been possible even as of 2 years ago or 3 years ago.
All right, I'm nervous to ask this question because I'm not sure that I want to know the answer. Is this amazing new technology at this point in time resulting in lower costs to the end customers, or are they basically paying a premium for same-day delivery while the partner is cutting off a huge piece of margin?
No, actually, in most cases, it's actually improved the cost structure. So it's actually brought it down. It's also increased transparency. It's increased speed. And the best part is it's actually made it more convenient to move money. And those are, I would say, the top reasons why corporate customers like using our infrastructure. The biggest thing is actually convenience, followed by transparency, followed by price and speed. We believe that, sure, there are some clients that are providing a better service and maybe charging a premium, but for the most part, our clients have actually made it cheaper for their customers as well. There's a tipping point after which the customer will like, hey, listen, I'm not going to pay 200, 300 basis points just to get the money there 1 or 2 days faster, right? So there is that kind of balance, that price optimization that is happening right now as well.
Makes sense. Mike, you've looked at, I guess, not just the stablecoin landscape, but also, I'm sure, many different startups at various stages that are operating in this space. What specific use cases have you gone most deeply on and even potentially invested in?
This B2B cross-border use case is something that at a high level is a main focus for us. That looks a little different in certain applications. So some companies are focused on particular regions. They are focused on, let's say, distribution to companies in Latin America who need to pay out contractors or vendors overseas. There's folks who are focused in Africa, in essentially markets that are challenging to build on and off ramps in. We think the moats here are around banking partnerships, regulatory licenses, this concept of last mile delivery, going from fiat to crypto, and then on the other end of the transaction, stablecoins back into the local fiat. That is where a lot of the value can be created and captured for companies like Layer 2. I view the market developing where you have regional experts in particular geographies, maybe even focused on particular use cases. Maybe there's companies that are focused on remittances or companies that are focused on B2B. There's companies that maybe are focused on corporate treasury management. If you're a multinational corporation, you have entities all over the world that you want to move money between, maybe there's a specific product to help CFOs and treasurers accomplish that. So at the application layer, I think there will be a proliferation of different types of use cases and geographies. And then I think there will be companies like Layer 2, who I kind of view more as like a long haul provider, if we're using this logistics analogy, to get money from the US to Europe or to India or to some of the larger, more liquid countries and currencies. We're also seeing some interesting use cases around spending your stablecoins. And so when people think about commerce, this is a relatively newer trend that we're seeing. But as people get more comfortable holding stablecoins, storing value with stablecoins, making payments with stablecoins, they also want to be able to spend their stablecoins. And so we're seeing an ecosystem of companies pop up that help individuals and corporates be able to spend their crypto wherever Visa and MasterCard and large card networks have presences. So this is an emerging use case on top of this cross-border use case that Bonu and Layer 2 is serving today.
Bonu, it sounds like your business, and I think you kind of mentioned this earlier, the term last mile, has at the highest level, and this may be rudimentary, but two components. There's the cross-border component, which is ideally facilitated using stablecoins. And then there's the, you could call it on-off ramp piece, you could call it fiat leg, you could call it last mile. So if I'm a company in Argentina that wants to make a payment to Turkey, I want to send local currency, and presumably the recipient wants to receive it in local currency. Now, probably there are use cases in which people are happy using dollars on both sides, but you have fiat and the recipient wants fiat. And in order to facilitate the cross-border component in stablecoin, you need to convert fiat to stablecoin on the way out. And then as the recipient's receiving it, stablecoin back to fiat. I imagine that's the hard part of the business. Sending stablecoins from one wallet to another is very easy, but that fiat leg is super hard. And one of the things crypto people are really good at is basically identifying a problem in finance that has been solved in finance, and then thinking it's a new unsolved problem, and then trying to solve it again, and making a whole bunch of mistakes in doing that. Correspondent banking has existed for decades. Fintech companies have been solving this problem for decades at this point. I appreciate that there's a lot in there, but maybe focusing specifically on that stablecoin versus last mile piece. And then we can talk about maybe the legacy of your predecessors that have worked on the same problem.
Let's take the Argentina to Turkey example, right? So Argentinian pesos to Turkish lira. If you're moving money from Argentina to Turkey, you could just go to a bank. You can say, hey, listen, I want to move money to a supplier in Turkey. And you'll be lucky if, first of all, the bank you're using is directly connected to SWIFT. Most times they're not. So you are working with a, call it small to mid-sized bank in Argentina that then has a correspondent relationship with maybe the bank that is connected to SWIFT. And you will then basically try to do a SWIFT from Argentina. That could take a day for the correspondent bank that you're using to then send the funds to the main SWIFT bank that then sends the funds out. That is easily a T+1, T+2 delay right there. money moving on Swift's actually not that long. And then it's on the Turkey side, money going from the bank, maybe your intermediary bank. The supplier is using, again, another small to mid-sized bank that is then using an intermediary bank inside Turkey to receive the funds. And there could be other intermediary banks in between as well, depending on if you're sending USD or if you're sending what currency you're using, right? So a lot of hops that the money will make or the messages will make before it gets to you. The other approach, I know I'm answering this question in reverse order. I think it's important for folks to understand how legacy works before what is it that we're doing differently. The other approach is that you can have, call it a fintech that has treasury positions both in Argentina and maybe has treasury positions in Turkey, or there are two sets of fintechs that have a partnership that have treasury positions in Argentina and Turkey, and you're basically debiting one side and crediting the other. So you're simulating the money moving faster, but money is not actually moving. No messages are going back and forth on Swift. The limitation with that is that you're limited by your treasury positions. So that model, that system works really well. The treasury system works really well for smaller transactions, for remittances, where someone's not doing,
It's the TransferWise model.
It is exact TransferWise model, right? It's really good for the remittance market because those are generally predictable. You know what the numbers are. It's about $1,000 to $2,000. You can build a pattern around it and hold enough liquidity. But when you're talking about corporate transactions that we see, these are very lumpy. It could be 100,000, a few 100,000, it could be a million, it could be 4 million, it could be 100 million, right? It's hard to hold that significant treasury positions to pay out. So what you're left with, you're defaulting back to Swift to move that kind of money. So what are we doing differently? What we do differently, and you kind of touched on it, is we would take the Argentinian pesos, we would leverage a local supplier in Argentina to get stables. We would then leverage blockchain to move crypto, move the money to Turkey, to a partner there to off-ramp that into Turkish lira. And then we would pay out in Turkish lira. Now, the advantage of that is that when we're leveraging the best banking partners in the region to collect and the best banking partners in the destination region to distribute, to do the delivery, and then you leverage an open ecosystem of liquidity partners, multiple liquidity partners to get the best rates, it's much more competitive than leveraging banks to move the money. And you can move it a lot faster. Speeds we see are not measured in days, it's measured in hours, measured in minutes sometimes. That just would not be possible in the other two models I spoke about, especially in the context of corporate transactions.
Okay, that totally makes sense. Maybe the natural follow-up for me would be, all right, so there are companies that using traditional rails do what layer 2 does. Now, it takes longer and it's more expensive. What's the likelihood that they look to integrate the stablecoins in the way that you do for the cross-border leg? My hunch, having worked in this industry for 10 plus years now, is that incumbents have a hard time moving on stuff like that, regardless of the economics. But I'd be curious about your view.
We believe the same thing. Listen, we have spoken to incumbents to try and integrate our stack in for faster money movement, some of the largest in the space. And their response has always been, well, we don't believe in it. We don't believe in digital assets, or our partners won't let us do it, or there's always a reason for them to not cannibalize their own business and their own model, because that's what it's going to take. It's going to take them cannibalizing their existing partnerships with existing banks and their existing model. They have to really just turn it completely upside down, because they make a tremendous amount of money by holding liquidity, by holding floats, by asking, especially the infrastructure companies, they will go to a client like a fintech or a neobank and say, hey, listen, if you want to move money faster, you have to give me $1 million, making a number up, keep it with me. I will make money on that money, and I will give you the privilege of giving you instant delivery, or your customers instant delivery, right? They'll have to completely disrupt that model. We don't ask our clients to hold pools of money with us because we don't need to. We move the money. So again, I think the incumbents, like you said, it's going to take them a long time to flip that model and make that change. And some won't.
I think I agree with you. Again, informed by experience. At the same time, partnerships are core to your business, right? Including with banks. Can you talk a little bit about that?
Yeah, absolutely. So as we spoke about, the last mile delivery is not going to be possible without the banks. And there are amazing banks out there. They're crypto-friendly banks that we work with that understand the power of what we're doing and that are there with us in terms of the potential. They provide us access to banking partnerships. And there's a number of them in the US, despite the current regulatory environment, which is improving considerably. But there's a number of banks in the US, in Canada, in Europe, all over the world that are seeing the light and are providing services to crypto companies to enable faster money movement locally. The other partnerships that are important to us are our liquidity partnerships and custody partnerships. When you think about custodians like BitGo or custodians like Anchorage, and when you think about liquidity partners like Galaxy, those partnerships are also very important to us to on and off ramp large sums of money, hold digital assets securely in transit, and then leverage local bank partnerships to push the money out.
Are there markets that are easier or harder for you guys to operate in from a regulatory or legal standpoint?
There are still many markets around the world that are catching up on crypto regulation. In those markets, we still provide a service. We leverage traditional fiat rails. One thing I probably should have mentioned is we are not a crypto company, just an exclusively crypto company doing payments. We are a payments company that leverages digital assets where we can and fiat assets where we need to. Because for us, we're providing a service to the customer. And over time, the goal is, we believe, very, very strongly believe that all markets, all money movement will happen through digital assets because it's just a much better way. But it's a transition. It's going to take 10 years. It's going to take time to get there. In the meantime, our clients still have needs. They still need to move money. So we want to be that one-stop shop for our corporate end customers to move their funds. So yes, that means us operating in markets and doing delivery in markets that are not crypto friendly. And we follow the regulatory environment in those regions and make delivery using normal channels.
Got it. That totally makes sense. And it's a point that we should have highlighted very early in the conversation. So your offering is basically, we will process your payments. That's the pitch to the B2B corporate customer. Not, we will process a small number of high-value cross-border payments or payments that need to be delivered same day or payments that need to be facilitated via stablecoin. The offering is, we will process your payments. And then you basically have built a platform that, I guess, routes payments via different routes depending on the jurisdiction, the currency, the volume, the time requirement. Is that right?
Yeah, there are many different, the algorithms in the platform are quite sophisticated based on industry, based on type of customer, based on retail versus corporate, based on jurisdiction that it's going. The system basically finds the best route to go through and executes on that route. And sometimes that route is a SWIFT transaction that we're out to displace. Sometimes that route is what we call our high-speed rails that go between jurisdictions. The system basically finds the best route depending on a set of criteria for a transaction.
In terms of your progress to date, the stage of the company so far, funding that you've raised, and I don't know, any stats that you can share, can you tell us about where you are right now?
I mean, the only stats I would share are just the growth of the company. I can't share specific numbers per se at this stage, but our volumes are growing 20, 30% month over month, and we process billions per year. And it's growing. It keeps on growing, which we're very, very excited about and very fortunate to be in that situation. We will at some point very soon share more specific stats as well around the level of money we move.
We'll look forward to that and see if we can amplify it when it comes out. The growth, is it primarily coming from you're plugged into X number of partners and they're just seeing a boom in their end customers who are using the services, or are your new partnerships also ramping up?
Yeah, it's both. It's clients that are ramping up, new clients that we sign that are ramping up and finishing the integration with their APIs and going live, and volumes ramping up. And as they see how fast transactions execute, they just keep bringing on more and more customers because their customers love the service. So they can sign more customers, but it's also new clients. The rate at which we sign new clients is also accelerating. There's a lot of inbound that's coming from various channels towards us from new clients as well. So it's a combination of both existing signed clients that are ramping, signed clients that are just getting going and ramping, and then brand new clients that are coming in.
Mike, what's your take on the medium, longer term competition in this space? How defensible do you think a company like Layer 2's moat is? And as you kind of project forward, it sounds like you expect more payment volumes to be facilitated by stablecoins. I think all of us on this conversation expect digital assets to power more of finance. In 3 to 5 years, are all fintechs and financial services companies leveraging digital assets, or does it continue to be kind of a niche opportunity that only the real innovators are delivering on?
I think we are 6 months into the S-curve of crypto payments. When you look back at December 2023, according to Visa's stablecoin dashboard, which has become my new favorite tool. Shout out to the Visa crypto team for launching this dashboard publicly. According to their very conservative estimates, the amount of volumes settling using stablecoins, particularly around these payments use cases, was about $1 trillion on a run rate basis at the end of 2023. The growth that Banu is describing over the last 6 or 7 months at Layer 2 really mimics the curve that we see at the market level, which is that $1 trillion in 6 months has become almost $3.5 trillion on a run rate basis. This is very underappreciated. People don't seem to really grasp in the market just the sheer scale of stablecoin payment volumes. For reference, that's 2x the payment volumes that PayPal did last year. So we're seeing massive adoption in a very, very short period of time. And it turns out that when you have an alternative infrastructure that can move value around the world 10x faster and a lot cheaper, there's pull in the market for that product and service, right? So it's in some ways not surprising, but it's also shocking in terms of how quickly we've seen the adoption. When people look on a go-forward basis, people talk about $160 billion of float in stablecoins, primarily in Tether and USDC today. A lot of different market estimates out there. We wouldn't be surprised if that number eclipses $1 trillion over the next 3 to 5 years. And so we see about $850 billion worth of kind of jump ball assets, float, TVL, however you want to describe it, in the stablecoin market, primarily being attacked by a variety of different issuers. So that's another part of the market that is very exciting. Folks trying to disrupt and displace the incumbent stablecoin providers. But stepping back to the near-term opportunity, we think the crypto settlement volumes are going to continue to grow quickly. Again, 3.5x growth in 6 months. Visa settled $12 trillion in transactions last year. The industry is sizable, but not all the way there yet, right? So there's still a lot more room to run. In terms of the competitive landscape and the defensibility, really the market opportunity is displacing Swift and the TradFi rails. I view it less so about how other alternative crypto companies trying to compete against Layer 2, and in this space in particular, I think the market is massive, and the traditional players are either going to grasp what's happening and try to partner with innovators, folks like Layer 2, to help reduce their cost structures to serve their end customers, or the business probably will flow elsewhere.
Guys, this has been an incredible conversation. I really, really appreciate your time. Compliments to you, Banu, on everything you guys are building, and Mike for the thoughtfulness and analysis that you bring to this space.
Thank you, Will, for having us. It's been a pleasure.
Yeah, thanks so much, Will. Really enjoyed it.
Banu Kohli and Mike Giampapa, thank you very much for joining us today.
Thank you very much, Will.
Thanks so much.
Thanks for tuning into Rebank. If you like today's show, reach out. Follow us on Twitter at Rebank Podcast and join the conversation. For more on banking, fintech, and the future, check out our regular content at www.bankingthefuture.com.